It's a marvelous night for a moon dance with the stars up above in your eyes. A fantabulous night to make romance neath the cover of October skies.
What's up, everybody? Welcome aboard to the Bubba Show. Todd Bubba Horowitz, and it's time for me to bring back one of my friends, a Bubba Report contributor, a Bubba Show contributor, and just an overall pretty smart guy who is on the phone with us from Japan, Damon Variel. What's up, Damon?
Not much. Last time we talked, I think we were in a pretty good market. This time we're talking in a market that's pretty much filled with fierce sentiment. So the conversation will probably be a bit different this time.
Well, so you talk about, fierce sentiment, and there are ways to identify different types of markets and different phases of markets. And, so when you're looking, Damon, I mean, you're a contributor, you're right for Seeking Alpha. You have a lot of your own stuff. You've got your website and you've got products that you do. So what does a guy like Damon Variel do and look for in markets like we see right now?
Because most of my trades are based on gaps and statistical patterns, I don't really follow the market that much. I follow the market, but I don't base my trades on market trends. That being so, I still look at the market because I'm interested in how I should attribute my long trades versus my short trades. So obviously in a bull market, you would have more long trades than short trades. Of course, you want to be hedged. You don't want to be completely long in a bull market, no matter how strong that bull market is. But you still need to look at the overall market sentiment to know overall how many, there's not a mathematical equation that I've come up with. But if you know that the market is looking not so good, you're going to have more bearish positions than usual. So we're talking now, and it's been 3 months since the so-called correction in November, where the S&P dropped below 2,000, and it's still not above 2,000. So what I'm looking at these days to figure out what I want to do in terms of hedging, in terms of how many sideways positions I have, how many bullish positions I have, how many bearish positions I have, I often look at volatility and where the market is. Because if volatility drops and the market's not back upward, a lot of people think that the VIX is associated with fear. And that's not really true, because if you look at what really the VIX means is volatility. And you can have a sideways trending market with low volatility. If you find volatility is low and the market is not trending upward or downward, it's very possible that we're going to have a sideways trending market for at least a brief period of time. And in that case, you don't want to have too many bearish positions or too many bullish positions. You want to be able to benefit from a sideways trending market. And in that case, you're going to want to play options, because you can't make profit from a sideways trending market unless you're very, very heavily invested in dividend stocks. So what I'm looking at these days is how volatility relates to the market trends. And what we've seen these days is we've seen a little bit of fear, not enough to cause a bear market at the moment, but we've seen enough fear to where people aren't going to be riding a trend where what I like to say is the fundamentals have gone outside of the technicals. What I mean by that is the economy is not backing up the trends in the stock market. So we have federal money being pumped in the stock market. We have companies who don't know how to spend the cash they're sitting on. So what they're doing is they're initiating buybacks, and that's reducing the outstanding shares and therefore artificially pumping up the prices of stocks. So we have an artificially high level of the S&P and any other indexes you look at. These are artificially high. The fundamentals don't back them up. If you look at certain valuations, it doesn't matter what type of valuations you look at, you're going to find most of the stocks in the market don't really have the fundamentals to back up the prices they're currently trading at. And with volatility at a high at the moment, we're not really sure what's going to happen. But we've seen volatility at lower points, even though we are still at a low level compared to 3 months ago. So what I'm thinking these days is eventually investors are going to realize that the fundamentals can't back up the level we're at the stock market, and we're going to have a correction at the very least and a bear market at the most. And we should be hedged for that moment. What do you think?
I agree. Now, of course, I'm a little bit more not systematic, but I look at the markets and I basically look at it at three phases, and I look at what time frame that the individual wants to trade on. I mean, if you're a day trader, you're trading on one time frame. If you're an investor, you're trading on another time frame. And I think that the sideways trending market you call, or what we really call consolidation or congestion, is one of the phases of the markets. In fact, I will go to say that the consolidation or congestion phase is the birth of all markets, and typically the market will rotate around the mean at that particular time, going back and forth, where the strong hands will buy the bottoms of the market, and the weak hands and the strong hands will switch sides and come and sell it down. And basically what we're going to make is a box or a rectangle, and it's going to be just churning sideways, which is very challenging for most to make money in there unless you know how to sell premium, or you're what we call a counter trend trader, where you're trading within that box. But overall, the market will break out again, and a breakout can be either to the upside or the downside. It'll again at some point form a trend. My personal opinion is the trend will resume lower. I think that this is just the start of a much deeper correction, and I think that one of your key cases here is on the volatility, which is basically built on the number of puts being bought to open versus sold to open now. That is certainly changed. So what we're going to see is probably a continuation of this bear market, and a market that is going to work its way. I think it'll probably be significantly lower. However, that does not mean that there will not be some what we call vicious rallies. And I think one of the key things for investors to understand about the market is when you see these unbelievably vicious rallies like last Thursday from 2:30 Eastern time, that everybody wanted to say that it was because of OPEC, which I say BS, but through Friday was more of what we would call a bear market vicious rally, and that is when they trap the shorts and markets go straight up, and people that are on the sideline are wondering, oh my God, how did I miss this story? And really all that's happening is we're seeing the shorts get squeezed out once again, and shortly here there will be, in my opinion, sellers that will step back in and push the markets lower. You cannot look at a market predicting, as many have tried to do, that we're going back to Dow 5,000. Certainly that's a possibility, but we would never create that type of fear cycle on our show, nor do we believe in it. The markets will work their ways at one level at a time, and that is how we see the overall view here. So I look for lower prices. However, there will be vicious rallies, and we come back for the break. I'm going to explain the difference between a bear market rally and a true bull market rally. We're visiting with Damon, who is the father of many products and many mathematical indicators that he uses in the market. He is a writer and a contributor for Seeking Alpha. This is the Bubba Show. Todd Bubba Horwitz. You ever miss an episode? LibertyTalk.fm will get you all the shows. We're going to stop out here for a break, and we're going to come back with Damon right after the break. This is the Bubba Show. Todd Bubba Horwitz. We'll be right back.
Stray cat sitting on the fence. Ain't got enough dough to pay the rent.
Traders, we've all bought books. We've all searched the internet. We're all looking for that magic formula. Well, I want to make available to you today my book, Bubba's Guide to Trading Options, absolutely free. Your only cost will be $9.95 for shipping and handling. The book will take you from the beginning of options trading to the end, giving you all types of market conditions, all types of scenarios, and the book acts as its own textbook because at the end of each chapter is a quiz to make sure that you're grasping what we're trying to teach you. It gives you the best idea of how markets really work, how they work in panic scenarios, how they work in bull markets, bear markets. It gives you all the details of how to best use options for your goals and how to accomplish it. All you have to do is go to BubbaTrading.com and go to my free book, $9.95 for shipping and handling, and that's all you need to do. Go to BubbaTrading.com and get Bubba's Guide to Investing in Options. Bubba's Investment Suite, the only tools you'll ever need to be a successful options trader in this business is go to my Bubba's Investment Suite. It's available to you on the BubbaTrading.com website under Bubba's Investment Suite. It offers all types of services that can help make you more profitable, give you a better chance to realize your potential, allowing you to make gains while also understanding that not every trade is a winner. So you have to make sure that you come in and learn the Bubba way and learn how to protect your portfolio, how to better manage it, how to better trade it. And you go to BubbaTrading.com and go to Bubba's Investment Suite. We meet once a week, and plus it gives you all opportunities to get and learn the option model better to make you a better trader. So go to BubbaTrading.com right now to Bubba's Investment Suite. Check it out. We'll see you there. Traders, do you ever feel lost? Do you ever feel unsure of what you're going to do next? Do you have trouble identifying market movement and market patterns? That's what my Monday night call is for. It's to give you the better opportunity to become more versed in markets and understanding what's going to happen next, giving you the best reads on technical analysis, helping you watch our current watch list so you can become better at trading. Now, I'm making a special offer right now that you can try that call for a $20 a month, 1 month trial. $20 a month gets you on Bubba's Monday night call, giving you all the tools you'll need to make yourself a better trader, a better investment, and a better idea of what's going to happen next in the market. It's all about technical analysis, so check it out at BubbaTrading.com. Like I said, $20 a month gives you a 1 month trial. You can check it out. That's 4 calls. BubbaTrading.com. Go there now. BubbaTrading.com. To the Bubba Show. Todd Bubba Horowitz with Damon Variel. Damon, a contributor of Seeking Alpha, does a lot of writing, has a lot of interest in the financial space, and is quite talented, as well as a contributor to the Bubba Report and to the Bubba Show. So as I was explaining, Damon, before we went to break, is that in bear markets, we see vicious rallies that are just, they're unbelievable when you look at them. But when you're in a true bull market, the rallies are grinding, and they're not explosive. They continue to grind higher, whereas in bear markets, I see this as an opportunity to go ahead and sell. All I need to do is find a good, solid level in which to sell against because, again, I will think we will continue the pattern we started, making lower highs and lower lows. What do you think?
Well, I think it's interesting that you mentioned the rally that started on Thursday, because on Fridays are typically with the lowest volatility out of all days of the week. But this Friday, we saw the market close 2% higher. And this is after a whole week where it's been closing roughly 2% lower every day. You said the rally began on Thursday, and that's exactly when Yellen mentioned that she would be willing to cut rates if necessary, which is very strange because she just recently raised rates. So ultimately, she has a bullish outlook on the economy. And these days, it's kind of weird because when you find bad news coming out, the market takes that bad news and assumes it's good news and then rallies. And I just don't understand really why many investors, and it might not just be investors, it could just be traders that are playing day trades, But the idea here is that they've already raised rates, and now people are talking about Yellen might be doing the opposite, moving backwards. I don't think that's very possible because she's a person after all, and she has to stick with her initial decision. And a lot of people are banking on 2016 having multiple rate raises. So, I mean, there's no reason to raise rates because usually you're going to raise rates if you have inflation problems, which we don't have at the moment. You have the dollar that's stronger than in any recent times. We've got a really strong dollar, and that's hurting the U.S. economy. But at the same time, Yellen's saying this is going to help the economy. So why would a rally happen after such a kind of counterintuitive mention about the U.S. economy? What do you think?
That's all. It's been the same for the last 7 years. You know, the free money, the accessibility of cheap or free money to the big guys is what has carried this market forward. And as you mentioned earlier, you know, I am not and never have been a fundamental trader. My mantra always is, if you want to invest, find a stock or a company that has good, solid fundamentals, but just because the fundamentals are good does not give you the green light to be a buyer or an owner of that stock at that point. You want to wait for the technical read. In other words, where we're either breaking out from an old level, moving higher, or coming down to support in an uptrend. Any number of reasons, but fundamentals of a company don't necessarily guarantee that that stock will go higher. Fundamentals just tell you the overall strength of the company. And then whether or not buyers want to buy, that will come in more on a technical basis as a trader. So we look for, you know, for my investing in business, I look for good, solid companies. But again, I will not buy or sell until the technicals tell me what to do. But the bad news is good news is, again, comes back to what you brought up, which is allowing companies to take cheap money and make their balance sheet look better by buying back more of their stock. But the real problem here is that, as we know from history, and those who fail to study history are doomed to repeat it, that this type of model never works when you have financial engineering, money manipulation, Fed intervention, and people that have no clue of what they're doing when it comes to running an economy. You will find that eventually this market will again collapse. And again, I don't want to wreak out fear here and have people worry that tomorrow it's going to collapse. I'm saying that we are going to, in my opinion, continue to work our way lower until the balance comes into the point where we actually see some real growth in this country. The problem in this country is there has been no growth unless you want to listen to the BS that is being spewed out by people at your Federal Reserve, people in the government. But you can talk about great jobs growth of 200,000 jobs a month, which is a paltry amount compared to where we were years ago. I mean, from my earlier days, I can remember prints in the jobs number of 800,000 and 600,000. And so we look at this, and we are still in the cycle of bad economic data, meaning that the Federal Reserve will continue to try to infuse their will on the market, usually will lead to market rallies. Now, I believe that in this point in time, that will end here quickly, because I think what's going to really happen here is people are going to recognize that there's a lot bigger trouble underneath the surface. What do you think?
I agree with that, and of course there's a lot of problems underneath the surface. But one of the catalysts of actually recognizing that in the market is being a trader or being an investor. And when you recognize the fact that 50% of the trades performed on the stock market are not from actual people, but from algorithms or from high-frequency trading hedge funds, then you have to divide the market into two groups. One is basically AI, artificial intelligence, who's making trades and then closing the positions before the end of the day, which is just contributing to volatility. Then you have the people who are holding positions that contribute to an or down movement overall in the market. But then you got to think about those people who are making those trades. How many of them are actual investors looking at the fundamentals of companies, and how many of them are traders just looking for short-term trends? And when you realize that probably it's half-half, you see that investors only have about 25% of influence over the entire stock market. So when you get all this news about, for example, Yellen, and you know it's going to be 50-50. Some investors think Yellen's going to raise rates. Some investors think Yellen's going to dip into negative rates because she has said that she wouldn't, quote unquote, take negative rates off the table. Now you've just got a bunch of confusing information for that 25% of the market movers. So overall, what we're looking at are technical indicators to tell us which way the market is going to move. But at the very, very basis of what we're looking at is a stock market that's artificially inflated. And, you know, if you want to go back to common sense, an artificially inflated stock market eventually has to crash because fear begets fear. And all the market crashes that we've seen in the past century have been the people at the top get scared, they sell the shares, and then it's just mimicry from there. And eventually what you'll see is people taking so much money out of the stock market that all of the stocks become undervalued, underpriced. And at that point, some smart people recognize that, and they get back in, and the market inevitably goes back to where it should be and moves forward and upward. And you just see this cyclical process until maybe one day the government starts to forget putting its hands into the market and trying to manipulate stuff. And maybe one day we'll have a real capitalist stock market where, you know, it's really supply and demand. But at that moment, at present, it's not like that. What we have are a lot of banks printing money and trying to manipulate shares to gain profit for themselves. And we've got the Fed, who is trying to deal with an overall sentiment that the U.S. economy is not as great as it really should be, and they're trying to fight that sentiment. So overall, we really have to fight our instincts to think, you know, the fundamentals are that great, so we should be selling and hedging and maybe buying a bunch of puts and taking our money out of the markets and putting it into bonds, because really that's not the solution when you've got 75% of the traders, of the actors in the stock market who are playing technical trades and not playing fundamental trades.
That's the words from my man Damon Variel. Again, a contributor to Seeking Alpha, has many of his own products, and a contributor to the Bubba Report. This is the Bubba Show. Todd Bubba Horowitz. We're going to stop out here for a break. Make sure if you miss an episode, LibertyTalk.fm. They're all there for you on demand. Be one of the hundreds of thousands of people that listen to the show all the time. We will be back after the break. This is the Bubba Show. Todd Bubba Horowitz, and we'll be right back with more from Damon Variel.
Jupiter and Mars. In other words, hold my hand. In other words, baby, kiss me. Fill my heart with song and let me sing.
Where have you been? We've missed you on the Sunday call. Every Sunday, 6:45 Eastern Time, Bubba goes over everything you need to know about options, how to trade them, what are the regular trades, what trades we're looking for, how to trade through earnings, and how to put yourself in the best position to be successful. Now, Bubba also knows that not every trade's a winner, but we get that, and what we're trying to work with is not only how to trade better, put you in the best position, but show you how to protect yourselves from bad trades and how to get out when they're not going the way that you think they're supposed to go. Every Sunday night at 6:45 Eastern Time, we're here to help you setting up trades. We update them every day. We send you regular updates. All you need to do is go to BubbaTrading.com and go to the Sunday call, and you can try that now. A special $20 for the first month. Check it out. Go to BubbaTrading.com and check out the Sunday call for options. Farmers and producers, we all know that you work your butts off trying to get the crops out. We all know that you're killing it trying to get done, and we all know that right now, with the extra strong dollar and all the other bad economic data around, that it's tough to even get out even. And I want to make sure that everybody understands that I offer, Bubba, a hedging program that will help you, the farmer, the producer, to lock in wherever you are and to be able to benefit from the upside as well as protecting yourself from the downside. We here at Bubba Trading believe in you guys and want to make sure that everybody gets the proper step and proper going. So go to BubbaTrading.com, go to my hedging program. We can help you find a better broker. We can help you get better commissions, plus the fact that you can either use the program on your own or we can help and work out a program specifically designed for you. That's BubbaTrading.com, the Farmers Hedging Program. Come on, guys, let's get it and let's make some dough. Bubba Show listeners, have you ever thought of being a day trader? How about stepping up and trying to be a part-time day trader first before you go ahead and give up that career? Well, Bubba has the answers here. We have now developed a pattern recognition trading system that will help you pick the right entry levels so that when you have time to trade, you can day trade futures as a part-timer. Instead of making a full commitment to a job, you get the opportunity to test it out, see if it works for you, see how the program works, and in all circumstances will make you a better trader under any circumstances. So go to BubbaTrading.com right now. Check out our futures as a part-time day trader program right now. As trading futures part-time, give yourself the best advantage to be successful in the volatile trading world. Go to BubbaTrading.com right now. Part-time day trading. What's up, everybody? Bubba here, and have you been watching the markets lately? Have you been seeing the crumbling of the walls coming tumbling down? Are you starting to get concerned about your long-term portfolio? Well, Bubba's got the answer here. We are now offering a brand new hedge strategy that has been only used by the major investment firms, and we've got all of the answers on how to protect that portfolio of yours without buying premium, without putting yourself in a bad position, and with the ability to still make money when the markets go up. So how would you like to protect that portfolio from going down and make money when it's going up? I can think of no better way to handle this. That's the hedging program. Go to BubbaTrading.com right now and check out our hedging program. We have two to offer, one for a bigger group and one for 10 people max. Check it out, BubbaTrading.com. Go there right now and check out the hedging program from Bubba Trading. Welcome back to the Bubba Show. Todd Bubba Horowitz with Damon Variel, contributor to Seeking Alpha, writes many of his own things, has many of his own programs, which he's going to tell us about, as well as a regular contributor to the Bubba Report, as well as the Bubba Show. So, Damon, I have the fortune of being the number one in my area anti-Fed guy. I think they've done a horrible job. I think that they've really dropped the ball at fixing the economy. But one of the things that I always want to make sure that everybody understands is that as far as a stock market, it doesn't really matter if you're trading, because if you're trading, you are trading the footprints that the markets leave, regardless of what the Fed is doing. And if you're investing and you're investing properly and you're hedged properly, which you've mentioned a couple of times, and especially through one of the programs that I offer, that you're always hedged and you never have to worry about market cycles where they go to bust, then you're in good shape, so it doesn't matter. And basically you're creating a compounding endowment model to continue to, when the markets are going down, actually taking money from the hedged portion and buying more equities, because we do know one thing for sure, that in the history of the stock market, it does go up 9% year over year, just not every year. So I believe the Fed has done a horrible job, but I know that, Damon, you have a number of philosophies and I've done a lot of work, and you know, we have a great thing going on here is you're a young man and I'm an old man, okay? So we all look at different views and we understand. So before you tell us about some of your programs that you do actually run, from your perspective, okay, and you're now living in Japan, which is was instituted the original quantitative easing program 30 years ago, longer than you're alive, I think. But when you look at what they've done and you look at what the Fed is doing now, what is your take as a student of the market, as a studier, and what's going on? How do you rate the overall Federal Reserve, what they've done, and how do you rate what's going on in Japan?
Well, my main fear is that the U.S. is walking the path of Japan, and eventually that they will move into the negative rate system that the Bank of Japan has recently imposed. And the problem in the U.S. is that Yellen, even though she raised rates a couple months ago, she is not only her, but people around her are talking about negative rates. And the reason they're talking about this isn't because it's been working for Japan. That's actually the opposite of the truth. After the Bank of Japan initiated negative rates, the stock market has crashed in Japan. All you have to do is just take a quick look at the index. Look at any index of the Japanese stock market, and you'll see that after the negative rates were imposed, the stock market crashed. Now, what I think is, if that happens in the U.S., and actually, if you want to look at that same time period in the U.S. stock market rallied after that. So this is going back to my idea that bad news is good news in the U.S. because if you're artificially pumping up the U.S. stock market, or if any news comes out that implies that there's going to be money pumped into the stock market, stocks tend to rally. So what's negative interest rates doing? Well, if you impose a negative interest rate, you're telling people don't keep money in the bank. Don't put money in a single place. Start investing it in somewhere that you'll be able to make money. And right now, the only decent economy in the world is the U.S. So you have a lot of people in China, for instance, trying to get their money outside of China so that they can invest it in the U.S., whether it be real estate or in the stock market. And if one day the U.S. goes into negative rates, well, we do have the advantage of the Fed pumping money into the stock market, but again, it's artificial. We don't have the fundamentals to back it up. It's not like the companies are doing better and therefore investors are putting money into those stocks. It's because the U.S. economy wants the stock market to grow. They simply put money into the stock market. And that's really dangerous for all the investors, especially investors, because investors don't trade. They're not looking at the market every day. They put the money in the market. They think, well, it's going to go up 9% every year, like you said, and they hope that's true. But once in a while, it's going to drop. And if it drops 30% from a correction, well, you've got a lot of people losing money. And then you have dumber people who are selling when it drops 30%, when it would be a much smarter idea just to hold on to that. But overall, any kind of intervention from the Fed in the stock market it's kind of like rigging the wheel on a roulette game. Now, we all know that it's already rigged in the stock market because two rolls of the roulette wheel are independent. But in the stock market, if you see a downward decline, you're probably going to see another downward decline for the next day or the next week or so. So you shouldn't be banking on independence in the stock market. But when you see the Fed interacting with the stock market, then you've got to consider what's going to happen. And you're not going to consider what's going to happen in terms of the fundamentals, which is sad because that's really what the stock market should be based on. You have to consider what other people are going to consider. And if they think it's good that the Fed is pumping money into the stock market and that the stock market's going to rally, they're also going to put money into the stocks. So we are completely out of alignment with the fundamentals. And that's something pretty much any investor and even traders, if you're going to be in a position trade, for instance. If you're day trading, it's not a big deal. But if you're going to be in a position trade where you're holding on for several weeks, that's something you have to consider.
Well, yeah, I mean, again, I'm not a fundamental guy. Me personally, I don't even read anything, about the markets because, again, I strictly trade off of the charts. I believe that the footprints, especially for a trader, are always correct. So when I look to make an investment, I will try to find a solid company based on its fundamentals, but I will look for a technical reason to get in because the markets are certainly challenged and they are pushed around by certain things. But at some point, we know that basically markets are driven by two things. They're driven by fear and they're driven by greed. And I see here at the levels where we are now is the greed playing in heavily. Even though we've had some major selling of recent vintage over the last 6 or 8 weeks, we still do not see what we would call the capitulation of the downside, which means that the fear has not been driven into the market yet. We can still see that people are still trying to jump in. And how do we know? Well, we can see that margin debt is at all-time record highs. And margin debt indicates that people are borrowing money to put it into the stock market, and they are investing money that they don't have. Now, the problem with that comes down to when the market starts to drop, if it does. And again, we're not saying that it's going to for sure. I just believe that's the case. But when the market starts to drop and people that are in that are over-leveraged, they are going to be forced to puke out their positions, because if you don't understand what leverage is, if you are leveraged in a stock, we'll just use McDonald's, okay, and you're leveraging McDonald's at 25 or 30 to 1, which many people get themselves into that position. Every time McDonald's moves $1, you're losing 25 times the amount. So you are going to put yourself in a position that you can never get out. And that is one of the problems, those are the problems that first show up in a market that is starting to turn the wrong direction for the average investor, which is up. Because what happens is leverage comes in and markets start to move. As volatility picks up, you are much more determined to have to make a decision based on your emotional status. Now, we do not believe in trading on emotion. We believe that you have to trade purely on the read of the market, which is why every time the markets open up on a big gap lower, I send out an email to all of my people saying, hey, sit back, relax, don't panic, because if you panic, you're going to be wrong for sure. You have to think of the market as an entity, and if you are over invested, in other words, if you are investing more than you can afford, if you're using the rent money or the mortgage money or money you don't have to get involved, you are sure to be one of the statistics of people that lost all of their money in the market, because it is without fail that the market will make a dramatic move at some point, and that decision will be you will have to make whether or not you want to live or not in the markets will force you to sell out, which is why tops are typically made when greed is the overriding factor and you see these explosions to the upside, and bottoms are typically made when overall fear has taken place and when you just see everybody selling. And that we call those patterns blow-off patterns, which indicate that the concern for price and time are no longer in the market, and that the people that are getting in, just get me in at any price. I don't care. I got to be a participant. And when it's time to sell, it's get me out. I don't care. I'm going crazy. You got to get me out of the market. And that is the overriding factor of the emotional market. Now, that will never change as long as there is human emotion and human beings trade in the market, which will be forever, because markets themselves have traded since the Stone Age, because there's always some market going on somewhere, because we do live on the theme of price discovery and the exchange of wealth. So that will always continue, and the common thread is always that people believe that this time will be different, which it never is. But we are with Damon Variel, from a contributor to Seeking Alpha, a contributor to the Bubba Report, as well as the Bubba Show. We are going to step out here for a break. If you miss an episode, the LibertyTalk.fm has every episode on demand. This is the Bubba Show. Todd Bubba Horowitz will be back with Damon right after the break. The Bubba Show.
The song was written by Fred Ebb and John Kander, orchestrated by Don Costa, and stolen by me. Start spreading the news. I am leaving today. I want
Tired of missing trades? Tired of missing out? Well, guess what, traders? I have got hooked up with MoneyBlock.com, our friend Andy Aronson, who does what we call letter of direction trading that can help you participate in Bubba's Sunday night call. And if you don't have time to make the trade yourself and you need somebody to watch your back for you, there's old Andy Aronson using the letter of direction that we send. He's out there managing your position for you, watching for you, and all you need to do is go to moneyblock.com and get a hold of Andy Aronson, or shoot me an email here at bubba@bubbatrading.com. We want to hook you up and make sure that you're getting the best deal. And not only are the trades done and done by letter of direction, but the commissions are compatible and favorable to any other service that you're using. So check out moneyblock.com, go to Andy Aronson, and if you have any questions, email me at bubba@bubbatrading.com. That's letter of direction trading to help you be better. bubbatrading.com. If you're not getting the Bubba Report from us, you are making a trading tactical error. The Bubba Report is a compilation of all of the top traders throughout. There's Keith Bliss out of New York, Scott Shalady, the cow guy from Chicago, myself, Damon Variel, and others that will help contribute to this book that give you a monthly summary of what is happening in the markets and what you can expect to happen going forward. Now, this is something that every trader is a must-have. It's a $99 a year for 12 issues of giving you market expectation and giving you a past read on what's happening in the back. All you need to do is go to bubbatrading.com and sign up for the Bubba Report. That will give you $99 a year for 12 issues. That's at bubbatrading.com. The Bubba Report, it's what you need to get started. The Bubba Report at bubbatrading.com. Traders looking for that perfect platform to become a better trader and take more advantage of the markets? Thinkorswim is that platform for you. It's built by traders for traders, gives you all the current tools that you may be wanting to use. Plus, it has the simplest ease of operation for the user. They offer classes every day to help, they call them swim lessons, to help you, the trader, become better at it. You get a special rate by telling them Bubba sent you. All you got to do is reach out to thinkorswim.com, but go to the website and you'll get hooked up with my special rate with Thinkorswim. And if you're from Canada and you've had troubles getting approved before, well, we've also got the same deal with TD Waterhouse. So Thinkorswim, built by traders for traders, daily classes, swim lessons every single day to make you a better trader, give you better advantage. That is Thinkorswim, built by traders for traders. Go to bubbatrading.com and check out the link. Welcome back to the Bubba Show. Todd Bubba Horowitz with Damon Variel, contributor for Seeking Alpha, contributor for the Bubba Show, the Bubba Report, a friend of the program, a friend of mine. So, Damon, I know you do a tremendous amount of research, and I know you're always backtesting theories and methods, and I know you've come up with a number of things. I know one of your methods is the gap trading method. But tell us about Damon Variel and the products that you use and why they work so well in the markets today.
Well, I wanted to get into that and not just to pump my own products, but you just mentioned a couple interesting things. And one of them was, you said you don't care so much about the fundamentals, but if you find a good company, you'll look into the fundamentals. It's as if you're filtering companies to do technical trades. Am I mistaken that you filter them through fundamentals and then you look at the technicals?
Yes, if I'm investing, I'm going to funnel them through. I'm going to find the good fundamentals and then look for the good technicals, because if I'm just trading, I don't really care. So yes, when I'm looking to buy something that I know is going to be for my future, it better be a fundamental company that has good, strong earnings, got growth, got money, because that's what I'm looking for. Yes, correct.
Right, if you're going long, yeah, of course. So, I mean, that's one of the problems I found with a lot of my students who get into my gap trading program. They think you only need to look at the technicals, and I have told them, and that's why a lot of them go with the phone coaching option when they sign up for the gap game plan. They want to learn the fundamentals as well. So a lot of them are just looking at ETFs, for example, the SPY, or they might even look at foreign ETFs, such as Russell, right? The RUSS or RSX. Those ETFs can be traded technically, but you also need to know the overall economy of that country that you're dealing with. And you also mentioned something about gaps. So a lot of people have this fear when they see an ETF, for example, gap down, and they think, maybe I should get out. Now, gaps are very confusing for a couple reasons. One is when you see a gap, you have a tendency, if you're a fundamental trader, you have a tendency to go look at the news and try to figure out why that gap occurred and then explain it through the fundamentals. I don't like doing that. I prefer using statistical analysis and looking at the candlesticks as well as the volume as well as the distance, like the standard deviation, away from the previous price to look at the gap and determine whether that gap is going to be a gap that widens or a gap that fills. Because it's not really that hard to figure out if the gap is going to fill or if the gap is going to widen. And that gives you an automatic directional play, whether you're buying stock, shorting stock, or playing options. So let's say after earnings, a stock gaps down. Now the earnings might have been bad, or they might have even been good, and you see this many, many times. The earnings are good, but the stock gaps down. And people are trying to explain why this happened in fundamental terms. But I don't think you can explain this in fundamental terms, because you're going to see the same thing happening regardless of what the earnings are like. If they're good earnings, you might see a gap down. If they're bad earnings, you might see a gap down. What's more important are the technicals after it gaps down. What happens? Because the gaps can explain the psychology of the people who are buying or selling. If it gaps down and you see a white candlestick, for instance, you're probably going to have a gap that fills. Because if it gaps down and immediately people are starting to buy, well, what you have is an earnings report that was probably not so good. This is just an example. Probably wasn't so good. The people who were holding on the stock and already made a profit were like, oh, well, I made my profit. The stock is not going to be so good in the future. Let's sell. But the next day, you see people buying it, and you realize that most people are thinking, hey, we're not at the real market value. We've got to buy the stock because it's going to, go up to what it really is worth. And at that time, you see that candlestick, and after that candlestick happens, and what I do here with these gap trading strategies is I don't day trade. All I do is I look at what the candlestick was the day after the gap, and I make a decision based on that, plus the volume, plus where the new price is. And based on those three indicators, I can guess with a pretty high probability which way the stock is going to trend. And sometimes it trends sideways, and that's fine because you've got high volatility after a gap. And if you've got high volatility, you get something called a volatility rush, and that'll help you on things like calendar spreads. That'll help you make a profit on calendar spreads. So after a gap, there's a lot of ways to make profit that you don't see when there's no gap in a stock. So if a stock is trending sideways, which is something you see with a lot of value stocks, it's just not worth playing options on in most cases, unless you're going to do something like an iron butterfly and you're going to hope that it trends sideways and you're going to make money off time decay. But if you really want to make a lot of money based on a directional trade, you've got to play gaps.
Okay, so you have come and you are more of an options guy now, okay? And, of course, I agree with that. I'm an options trader for 36 years. People believe that options are complicated, they're tough. What do you say?
At the very beginning, you'll think it's tough because think of it like this. If you buy stock, you have to make one decision. Are you going to buy or are you not going to buy? When you buy an option, you've got to make multiple decisions because instead of just buying or shorting, you've got buying or shorting, puts and calls, and then you have complex strategies. And when you first dive into options, so what I really don't recommend for people who are just getting into options is buying a book on options, because they're going to give you like 10 different options strategies, and you really don't need that. Start out with the most basic stuff. Start out with a call option or a put option, just buying a call option and a put option. It's basically the same as buying stock or selling stock, or shorting stock, sorry. But the only difference is you have to make two more decisions. One is strike price, one is expiration date. And I can teach you how to choose the appropriate strike price and expiration date. But once you get that down, and it doesn't take a long time to get that down, once you get that down, you can start incorporating multiple options per trade. And that's when it really starts to hit you that it doesn't matter which way a stock trends. You can buy volatility. So what that means is if a stock goes up really high, it doesn't matter which direction. If it starts to move with high volatility in one direction or the other, you can still make a profit. You don't have to be right in terms of the direction. Alternatively, you can look at a stock that's been trending sideways for a while and you predict that it will continue trending sideways. You can actually make profit on that guess. And that's not something you do with just stock. You can't short stock or buy stock and make money if the stock trends sideways, unless it's a dividend stock, of course. But these are more complex strategies, but they just build upon one another. As long as you learn how to buy a call option, how to buy a put option, then you move to the next step. How do you sell a call option? How do you sell a put option? Those four things put together in multiple methodologies will teach you a myriad of ways to make profit on pretty much any type of stock trend. But I specialize in buying stock options after a price gap because it's really hard to predict a price gap. And backtests on earnings reports have shown that if you want to predict a price gap, even if you know that there's going to be a weird gap after earnings report, you're not going to be profitable. And I think you and I were talking about this the other day. You could probably, you may, if you got time, you may as well just explain what you were saying before about predicting a movement in the stock price after earnings report.
Yeah, and unfortunately, we don't have time for that today. We'll have to do it on another day. But Damon, great insight, and it's always good to get somebody else's opinion and the way that we do things. And I think that it's great to have you on. I appreciate you coming on today.
Thank you.
This has been Damon Veriel, a contributor to Seeking Alpha. You can read many of his articles. He's a big writer. He's a big contributor and a big writer to the Bubba Report as well as the Bubba Show.
And if you're interested in my course, go to the Bubba Show's website and just go to the store, and you'll see my price gap trader course in there.
And you will see his course on the Bubba Show, and you can check it out. And of course, if you have any questions, email me and let me know. We'll get you in touch with Damon. But this has been the Bubba Show. Remember, if you missed an episode, libertytalk.fm. You can get all of them on demand. That will do it for today. Damon was great, bringing us some very good insight for the average guy. And this is the Bubba Show, Todd Bubba Horse. We'll see you back here tomorrow, same time, same station. Thank you so much, everybody. We'll see you tomorrow at the Bubba Show, Todd Bubba Horse.